how do you go about identifying just market breadth and then what sectors you view are strong performing versus weak performers?
All right, net new highs. Net new highs. The reason I never called this a bull market, I called it at best a transitional bull. When the market started to go up in January, February this year, the new highs never confirmed. Almost most days throughout the year, we had net negative new lows over highs. We never got into bull confirmed status. We had brief periods where new highs would ellipse new lows. But not only that, the new lows right now are getting into dangerous territory. We are not in every bull market has pullbacks and net new lows exceed new highs, but they're marginal. 40 new lows a day, 100 new lows a day, 50 new lows. We're running big numbers here. We're not in a bull market pullback according to new highs, new lows, and the bull market never transitioned from a bear to a bull. Right there. Now, that's one thing you asked me to qualify. What was the other one? On breadth? You said breadth, and what was the
Yeah,
other?
breadth was the first one. And then the other is just analyzing sectors to find what sectors you like to the upside, to the downside.
I screen for everything. So I'm generally going to all of a sudden start to come up with diverging RS or RS, leading RS. I screen for that all the time. Leading RS in a pullback is gold. It's pointing you right to what the market loves. So leading RS is a great screen, but when you start running screens like that or up to down volume over say 1.5, it's going to point you right to the leaders. And all of a sudden you're going to start to see a whole bunch of crop of these, whether they're, shipping stocks or hotel stocks or semiconductors. And then I'll look at the group and then I'll distill down, I'll break down into what's the leader within the group. Now, here's the issue. Anybody can find those through screening, but how do you know which ones are buyable? And usually when you find it, you're going to be late and it's going to be really extended. That's the third biggest rookie mistake is buying extended. You're like, I found the number one group. I found the leader in the group. It's got everything, but now it broke out from, it's 75. It's 95 now. It's 20 points over the breakout from the digestion. But if you're a rookie, you just buy it and then it pulls back and you're like, it was the right name. It was the right sector, but your timing was off. You don't understand congestion digestions. Bases, chart patterns form, they're just digestions, whether it's a flat base, a cup and handle, a double bottom, head and shoulders, they're congestion areas with support and resistance. If you're buying extended from the last digestion, you're a rookie. That's probably the fifth one.
Now, how do you balance, especially if these are longer term thesis, right? Like if we're looking at a 3-year weekly chart, that seems like a pretty long thesis. If there's a breakout, and I actually remember spending a lot of time in Bill O'Neill's book on this because I found it so interesting. It seems fascinating to me how imperative it is to get that initial timing right, even though this can be a really long thesis. It seems like if it's a really long thesis, you would give yourself more time, more variance. But obviously his argument is you get to reduce a lot of risk if your timing is very good. So how do you find that balance between getting your timing as good as possible, but then also getting into something that you're expecting to run for the next year or whatever it is?
Two things.
Okay.
The only time you're going to find a 99 comp stock with sky high RS in a base is in a bear market. Because the second that bear market ends, I call them basketballs underwater. It's just going to pop straight up and it's going to be extended into a day. So if you don't catch it on that day, you're now buying extended and your risk is up. Now, the second part of it is it's not just enough to catch it at the right point. You have to catch it in size. That's probably one of the most underrated things. And I can't overstress this. I said, this is really important. Well, cushion, the value of cushion, until you have experience, you can't understand how valuable it is. If you don't have cushion and you are using risk management, you're living on a razor's edge. And if you're a moron and you have a TML right after a bear market and it's up 20% and you take that gain, now what? Now it's extended. How are you getting back in? Over the 98.4 weeks, most TMLs go up like 400 to 1,000%, and you sold it up 20 at the end of a bear. Fool's move. So it's not just how do you catch it not extended, but you have to catch it in size, because if you have 10% of your account in a stock that goes up 100%, your equity moved by 10%. How often do you get a 100% gainer? Well, then you better have more than 10%. Now the problem is when you're transitioning from bear to bull and you're used to buying probing positions of 100 lots, but you really intend to buy 200,000 shares, but you're probing, see if you get traction. All of a sudden you get traction and you feel like you're beaten down because you're probably down for the year. You've lost money. You're in a bear, but you need to go put 20% of your whole account in a stock at the right time. That is only done with experience. No rookie, very few. I will bet every time that you get a guy who reads Bill's book at the end of a bear market, they are not going to get the right stock and the right size. I'm not. I'm going to buy in the transition phase. I'm going to buy 5 or 6 stocks initially, probably buy 3 on the follow through day. I'm going to have to, you're building positions. Most stocks I buy, I'm wrong. 6 or 7 out of 10 don't work, even when I buy them on the breakout day. So that's 3 out of 10. It's a shifting matrix, only to be understood through time, understanding deeply where you are in the trend in the market. What is the general market? How is it acting? Is it appropriate now? This can take decades to learn. Okay, I just explained it to you in a very cursory fashion, but to really learn it where it's like catching surf. There's normal waves, then there's gigantic waves, and then there's waves that come around every 5 years. Well, you have to stick around for 20 years to be through the 5 big wave periods to understand, man, now it's time to throw the hammer down. Okay, we got to open fire right now. It is go time. You're in the breach. There's no flinching now, and it's worth the risk. That's when I can take risk. I'm willing, because I know that the odds are high enough where if I'm wrong, it's worth taking that risk. But in a crappy market, in a perfect 99 comp stock that limps out of a base, I'll throw something at it to test it. It's more of a test. I'm not even trying to make money. I'm trying to determine if the market's ready for me to go all in. I'm waiting. It's like playing Texas Hold'em. I'm waiting for the right setup. What do I have? What's showing? It's early. And now I want to slow play it to get them all in, but I need to ramp that pot up. I need to make it worth my while.